What is going on, investors? Hopefully you guys are doing well out there. And on today's show, we've got to have a serious discussion. And this discussion has to be about all the fake AI companies that are going to be reporting their earnings over the next couple of weeks. They are going to get out in front of investors and analysts and have conference calls and have the executives say AI as many times as they possibly can on conference calls and in press releases and try to fool investors like yourself, which may see fancy words and fancy dialogue and presume that the company, which may have a big name and a big market cap and maybe a big share price, and assume that, boy, they must have some big AI plans. But the bottom line is there are some real fake AI companies that are going to report. And maybe the biggest and fakest AI company to report was today. And that was none other than Intel. Ticker symbol INTC. This company is the fakest AI company on the planet. How do we know that? How do we know that this company is the fakest AI company, despite Pat Gelsinger getting on the conference call and saying AI, according to my find and replace, over 30 times on the conference call? It is because the numbers don't lie, because as we've looked over the past year, what has happened to the semiconductor industry, particularly the ones that are leading the way? You look at Nvidia. Nvidia has absolutely put out blowout numbers every single quarter for the last 4 quarters. In fact, they've beat and raised by multiples unseen by the stock market in years past. Unbelievable type quarters as it relates to revenue growth and it relates to forward guidance. That is because Nvidia actually makes a real AI product that is in demand. We also look at second place, if you will, in the semiconductor industry as it relates to AI. That is Advanced Micro Devices, otherwise known as AMD. Subscribers to the channel and the newsletter know AMD quite well, because back in July, we actually recommended AMD shares at about $115 per share. Well, since then, it's been more or less a straight line up, as AMD is up over 54% since we publicly recommended buying AMD shares back in July. AMD has a viable alternative to Nvidia's products in the AI marketplace. On top of that, AMD has a diversified portfolio for the server market, for the gaming market, and the PC market. And as Intel results will show you, it is absolutely crushing and eating Intel's lunch. And somehow Intel, at the same time as they're getting their lunch eaten by AMD across gaming, PC, and the data center, somehow they're going to convince you that they're going to compete against TSM, the largest foundry in the world that actually manufactures the chip. Somehow Intel is going to compete in that business starting in the year 2030. I'm here to tell you that none of that is going to be true. And it all is proven out by the numbers. As Intel reported their Q4 numbers, they also gave us first quarter guidance. Those revenues expected to become between $12.2 billion up to $13.2 billion. The problem with that, folks, is while $12 and $13 billion is a lot of money, Wall Street was expecting a number closer to $14.2 billion. Also, complicating the situation is Intel just put up a quarter where they did $15.4 billion worth of revenue. So unlike Nvidia, unlike AMD, we're actually seeing revenues fall off the cliff over at Intel, which shows to me and proves to me that any AI product that they have should be flying off the shelf. Certainly isn't. Also, when you dig in the numbers over at Intel, you had $54.2 billion worth of revenue over the past 12 months at the chip maker. Unfortunately, last year, they had closer to $63 billion. Now, more unfortunately than that, after you factor in the cost to make the chips, also research and development, and sales and marketing, Intel managed to squeak out just $93 million worth of profit. Now, $93 million of money is quite a bit of money, but when the company is worth over $200 billion and trades at 51 times forward earnings, $93 million full year's operating profits, certainly not going to light the world on fire and not going to get investors very excited. Also not going to get investors excited is the fact that over the past 12 months over at Intel, you had $11.5 billion worth of operating cash flow. Operating cash flow is the actual cash profits that flow into Intel. It doesn't take into account things like stock-based compensation, which is non-cash. Also things like depreciation, which again is more or less an accounting charge. Now, the problem with $11.5 billion worth of operating cash flow for Intel over the last year is the fact that the company paid out $3.1 billion worth of cash dividends to shareholders. So in actuality, minus dividends, you're producing less than $9 billion worth of operating cash flow. Now, the big problem is Intel is trying to convince investors that it is going to become a foundry. A foundry is what TSM is to the chip world. TSM manufactures all the chips for Apple, Nvidia, AMD, even Intel manufactures a lot of their chips at the TSM foundry in Taiwan. Intel is trying to convince not only the United States government, but investors as well, is somehow it's going to infringe on that space and be able to invest tens of billions of dollars over the next couple of years just to be able to start that business up, let alone compete. Unfortunately for shareholders, is Intel spent $25.8 billion on property, plant, and equipment over the past 12 months. $25 billion is obviously well in excess of the $11.5 billion worth of operating cash flows before they had to pay a dividend. It also represents about half of the company's revenue. That also makes the Q1 guide between $12.2 billion and $13.2 billion worth of revenue even more worrisome, as last time I checked, those foundries aren't even built yet. So I would expect a hefty amount of property, plant, and equipment spend for Intel over the next 12 months. Now, how is the company going to pay for it? Well, you guessed it, by issuing long-term debt. Over the past 12 months, the company issued $11.4 billion worth of long-term debt, which was about as much as operating cash flow as the company produced. Considering interest rates are no longer zero or damn near negative for these corporates, I guarantee you Intel borrowing that $11.4 billion comes at a rather hefty interest rate. Folks, there's going to be a lot of fake AI companies that report their earnings. On the software side, you actually can get away with it. The recurring revenues of software and the natural likelihood that many businesses simply renew their software on a yearly basis can create rather steady revenues for software companies and give them time to create AI products that rival maybe the likes of Microsoft, Salesforce, and ServiceNow. Unfortunately, in the semiconductor industry, that is not the case. You have competitors like Nvidia, AMD, and TSM, which are so far out in front of Intel. The fact that this company with a straight face can tell investors and the investing community alike that it is an AI company is an absolute disgrace. I would avoid companies like Intel at all costs, despite the fact that the shares have performed relatively nicely over the last year. Compare that, though, to the broader semiconductor industry, and certainly compare it to AMD and Nvidia, and it certainly is playing catch up. And catch up is what Intel will be doing for the next couple of years. Hopefully you enjoyed today's video. We'll be back again next week. Enjoy your weekend. Bye for now.